market's holding out quite well despite what we're seeing on the COVID front. In fact, you do have the frontline indices as well as the broader universe that's seeing quite a bit of traction despite the kind of on-ground realities that we're seeing with respect to COVID. We connected today with Taher Badshah of Invesco just to understand what his view is on the markets, where he's seeing potential, where he believes one can look to invest in, what the second wave essentially means this time around from a market standpoint, as well as some sectors that he's overweight and underweight on. Well, Taher started off by saying that there's been an element of negative surprise, but that's not as much as what we witnessed last year. He also says that there is a greater amount of familiarity with ways to tackle the COVID crisis, and that the lockdown this time around is more localized in nature and it's not as severe as what we saw last time when everything came to a complete standstill and there was a nationalized lockdown in place. He said the evidence of a vaccine rollout, there is evidence of a vaccine rollout actually having a great impact overseas, and in other countries it has helped in curbing COVID, and the hope is that we will see reasonable recovery kick in about a year's time, and we will see the vaccination drive actually helping and improving the situation at hand. As of now, with respect to the overall economic activity, he says the contraction of economic activity is not as much as we witnessed last year, and he believes that you should go ahead, investors should buy the dips, buy the bad news, but keep your expectations in check. Don't have expectations of phenomenal returns. In terms of sectors, Taher Badshah says that global cyclicals are in a much better place right now as compared to the domestic cyclicals. And he believes that he's spotting value in financials, cyclicals, as well as industrials. In the long run, he believes that consumption-related stocks or consumption-linked stocks, they will still take some time to recover owing to what we're going through on ground. He believes that there is a lot of opportunity as well within the broader markets, and investors can look to find these opportunities in the long run. Going forward, he expects the impact of the pandemic to ease at some point and at some stage, and as of now we are still on course to achieve the economic recovery that had been anticipated. We're also facing the problem of migration of labor. This is impacting sectors like infrastructure, capital goods, but he believes it's not as severe as what we saw last year, and that the dent on capital goods is not likely to be as severe as it was. The small-scale retail businesses, he believes, will be adversely impacted. There is an unorganized to organized shift, and that is only going to accelerate. He's been overweight on IT over the last few quarters, but has reduced a little bit of weightage right now. A balanced portfolio approach is what is being adopted, and he is seeing divergence in autos as well as banks, and they're underweight on FMCG and marginally underweight on telecom as well.